Joining us now, Allianz Chief Economic Advisor Mohamed El-Erian, and your point is that nothing that Powell said should have been that surprising. There's a lot of uncertainty. There's downside risk, but I would say, Mohamed, we were down. Probably we had recovered a lot of the losses, and we were only down about 15% as of yesterday or the day before. I don't know, maybe a little bit more than that. And so he said these things, and we go down another 500. So I don't know how much what is that? That's not even 2%, I don't think. So, but we're down again today, and we were down earlier this week, 450. So we're down over 1,000 points. None of this may have anything to do with what Chair Powell said in just terms of him describing reality that we all know.
So, Joe, we've had these three phases that you and I have talked about. Phase one was the very sharp correction when we realized that we had an economic sudden stop. Phase two was a reaction to policies. So everything at it, we came back strongly but partially. And phase three for the last month has been volatility towards slightly lower. We are lower for the last month, except for the NASDAQ. And what you see happening now is a tug-of-war between continuously worsening fundamentals and policy hopes. And what Chair Powell said yesterday, there was nothing surprising about how he described the economy. We all know it's highly uncertain. We all know there's downside risk. We all know that liquidity can turn into a solvency problem. Just watch Squawk every morning. That's repeated over and over again. What the markets were hoping for was a stronger policy message. They were hoping for stronger policy guidance, and they didn't get that. And it tells you that this market needs continuous support from the policy side in order to, in my view, overcome the weaker fundamentals for now.
Yeah, I guess you're talking about there was one day on the 17th of April where that was a high for that rebound. At that point, we were at 28.74. So we are below that, but we've been alternately above and below that number. So we're basically flat for the last month, but it's been, you're right, it's been turning around. So is it we're back to Fed moves or science moves to dictate or reopening moves? I guess there's three different ways of trying to decide what the market keys on, Mohamed.
All three, depending on what type of investor you are. Look, I have said continuously, and you push back against that, it's much easier to make a judgment about specific companies and four attributes in particular that I've stressed than it is to make judgment for the market as a whole. And those attributes have actually outperformed both on the way down and on the way up. And they're positive for the year, significantly positive for the year in some cases. So look for particular attributes. That's what's going to navigate us through. If you're a tactical investor, you're looking for policy. If you are more of a strategic investor, it's about science and reopening. And I think that the reality is we are a mix of everything. So I'd rather build it up from the bottom than top down.
Yeah, I don't know whether it's been, when you say quality means different things to different people. When you say raise your quality, that sounds like, strong balance sheets and staying power. But in this bifurcated market, it's been about pandemic winners, Netflix or Amazon or Spot, any of the companies that can actually flourish in this bizarre closed down economy that we find ourselves in, I guess. And they need to, I don't even know if they need to be strong financially, because a lot of them are making a lot of money just based on dealing with this current situation. So you needed, I guess, to look at the winners versus the losers. Obviously, cruise lines and the airlines were not a place to be.
So, Joe, I suggested four attributes for the last, I don't know how long. One is strong balance sheet, which means either no debt or little debt, or means access to capital. Two, positive cash flow. Three, strong management teams. Four, what you just said, on the sunny side of both the COVID shock and the post-COVID world. There are companies that meet those four criteria, And they've been doing relatively well in this whole environment. And I suspect they will continue to do well. I have no issue with the relative pricing. Where I and others sort of wonder is the absolute level of markets.
You think we go, when I see Trump talk about negative rates, he's so, as a real estate guy, he's so just straightforward. And there were times in the past when he was telling Jay Powell, you need to do this, you need to do that. And it sounded simplistic, almost too simplistic, but then some of it actually came to pass. Do you think that the record is significant enough and that what happened over where it's been done, where you didn't get the desired results, does that prove that we don't want that here, Mohamed? He said that's the one thing he disagrees with Jay Powell on now, is that maybe we need negative rates. We got the strongest currency. We got a very strong currency. We could do it. We could get paid to lend money. Does it make sense?
So it depends what you're targeting, Joe. If you're targeting asset prices,
money. I'm sorry,
if you're targeting real estate, sure, negative. Yeah, if you're targeting asset prices or negative rates, or the real estate, yeah, go to negative. But if you're targeting the economy, it's not going to have much impact. And then you've got to deal with the collateral damage and the unintended consequences. The evidence from Europe is that so far, the cost and risks exceed the benefit for the economy as a whole. It doesn't mean you don't get different compositional issues. That's why the market is pressing for lower rates. The market is pressuring the Fed really, really hard to do more, both on credit support, where the Fed is already doing a lot, and also on negative rates. That's what the market wants. It's not clear that the economy would be better off. And what is absolutely crystal clear for me is that the credibility and the standing and the political autonomy of the Fed would be weakened.
What kind of, is it, we looking at a Nike swoosh? It's not a V, it's not a U, it's not an L. What is it now? You got a symbol for it? Maybe it's Elon Musk's kid. It's
a series of W's.
It's a what? A W.
So it's a series of W's. No, think of a pendulum. We swung from everything fine to complete shutdown. Now we're having partial unsynchronized reopenings. Some of them are going to go well. Some of them are not going to go well. And the pendulum is going to continue swinging with lesser and lesser magnitude as we learn to live from the virus. The good news in all this, leapfrogging in scientific discovery. We're learning a lot more about the virus every single day. You've heard me say every single day is a win because we learn more. And we're starting to realize we're going to have to start changing things we do. I'm so glad you have Eric Schmidt on. He will tell you how we live with this virus. And we're going to learn to live with this virus for a while. So we're going to swing one way. We're really excited about the reopening. Then we worry about infection rates spiking. But these swings are going to get lower and lower in magnitude as we go forward.
And if you could design something fiscally now between what the Democrats want to do and what Republicans want to do, what would it be?
I would do two things. One, to win the war against the depression, I would continue to look at relief measures aimed at the most vulnerable segments of society. And as Tom Friedman just said, the amount of pain out there is significant, and we don't want short-term unemployment to become long-term. But I would also be spending a lot of time right now, not just winning the war, but securing the peace. And what I would look at infrastructure programs. I would look at labor retooling. I would look at labor retraining. I would look at better safety nets. We've got to make sure we don't come out of this with higher debt and lower productivity and less dynamic demand. If we do, it's the new normal 2.0, and this new normal 2.0 is going to be a lot worse than the first new normal of inadequate and non-inclusive growth.